Hey there. You ever find yourself scrolling past headlines about a massive global company? The kind that dictates what we buy, how we live, maybe even the future of tech, and just wonder what's really going on behind the scenes? Who's actually pulling the strings? Well, today we're doing exactly that. We're taking a deep dive into the absolutely critical world of corporate governance. Our mission here is to really unpack it, what it is, who's involved, and why these sort of invisible structures have such a huge impact on how companies perform, their ethics, everything really. We've got some fascinating insights lined up for you.
That's right. Yeah. Corporate governance, it sounds a bit formal, maybe abstract, but it's basically the rule book, the whole system for how a company is run at the very top. It's about who's accountable, how decisions get made. Understanding it gives you this unique lens, to see past the PR and grasp the real power dynamics. We're going to connect some dots today.
Okay, let's unpack this then. Starting right at the top, we often focus on the CEO, but the real stewardship, the legal responsibility, that sits with the board of directors, doesn't it? But who are these people, actually? It's not just a random collection of names, is it? What makes up an effective board?
No, absolutely not. It's typically quite carefully constructed. You generally have two main types of directors bringing different things to the table. First, you've got your executive directors. These are the senior managers from inside the company. Think CEO, finance director, maybe the COO. They're the ones, up in the day-to-day. They know the business inside out. Their value is that operational knowledge.
Right, so they've got their hands firmly on the wheel, steering the ship day to day.
Exactly. But just having insiders isn't enough for good governance, right? You need
Well,
that outside perspective too. And that's where the non-executive directors or non-execs come in. These are people brought in from outside the company. They often have serious management experience elsewhere, maybe specific expertise law, tech, finance, whatever's needed. Their key role. Independent oversight.
so they're there to challenge the executive team. Keep them honest, kind of.
Precisely. To scrutinize performance, question the strategy, bring that objective viewpoint. Make sure management isn't just operating in an echo chamber. And what's really interesting now is that big investors, like pension funds, they're increasingly getting seats on boards too.
So they want direct influence over their investment.
Exactly. They want to make sure the company's strategy aligns with their long-term goals. It adds another layer of accountability.
Okay, that makes sense for the typical, say, UK or US Model 1 board. But you mentioned different structures, like the dual board system.
Yeah, that's right. Germany is the classic example. They operate quite differently. They have a management board, the Vorstand, which handles the day-to-day running, much like our executive directors. But then above that, there's a completely separate supervisory board, the Aufsichtsrat, and you can't be on both.
A separate board just for oversight. What's the thinking there?
Well, it really emphasizes a much stronger separation between management and oversight. It's designed to build in more checks and balances, maybe provide a more stakeholder-focused view rather than just shareholder primacy. For instance, in Germany, employee representatives legally have seats on the supervisory board. It's called co-determination.
Wow. Okay, so employees get a formal, say, at the top level. That's fundamentally different.
It is. It reflects a different philosophy about who the company is accountable to. The single board system, common in the US and UK, argues for efficiency, faster decisions. The dual board, perhaps a bit slower, aims for, let's say, more robust oversight and broader representation. It just shows there's no single right way. Different systems prioritize different goals.
That's a really clear distinction. Okay, so with that board structure in mind, let's zoom in a bit. There's this key debate within the leadership structure itself. Should the jobs of chairman or chairwoman and chief executive be held by the same person or two different people? It sounds like an org chart detail, but I get the feeling it's pretty significant for how power works.
Oh, it's absolutely fundamental. And there are strong arguments on both sides. It really splits opinion. Those who argue for separating the roles, they focus on preventing too much power ending up with one person. The CEO runs the company, executes the strategy. The chairman or chairwoman leads the board, sets the agenda, oversees the CEO. It's about checks and balances, ensuring the board is truly independent in its oversight.
Right, so the person reporting to the board isn't also running the board. That makes logical sense. Avoids a potential conflict.
Exactly. But then there's the other side, the argument for combining the roles.
Okay, what's the case for that? Why give one person both hats?
Well, the supporters believe it provides stronger, more unified leadership. One clear voice at the top. They'd argue it can lead to quicker, more decisive action, especially, say, in a crisis or a fast-moving market. Less potential for friction between a separate chair and CEO. Think of some, iconic founder CEOs who also chaired their boards during periods of massive growth.
So it's a trade-off then. Decisiveness versus independent oversight.
That's pretty much the core tension, yes. Balancing strong leadership against the risk of concentrated power. The choice a company makes here really signals a lot about its culture and priorities.
Is there a trend one way or the other? Are companies generally moving towards splitting or combining?
The general trend, especially among larger publicly listed companies, seems to be towards separation. This is often pushed by big institutional investors and governance reformers. They really value that independent board leadership, especially after, various corporate scandals where maybe oversight was lacking.
Right, pressure for more accountability.
Exactly. But it's not universal. You still see combined roles, particularly in certain industries or company life stages. It shows these structures aren't set in stone, they adapt.
Okay, fascinating stuff. Right, let's shift gears slightly to something that, well, almost always grabs headlines.
Hmm.
Executive remuneration, pay, compensation. How are top executives actually rewarded, especially when things go well? It's not just salary, is it?
No, not at all. Base salary is just one part. When executives hit their targets, a big chunk of their reward usually comes from performance-based incentives. Short term, that might be cash bonuses tied to annual profits or market share goals. Longer term, and this is often the really significant part, it involves things like share options or stock options, as they're called in the US.
Okay, stock options. How do they work, basically?
Well, they give the executive the right to buy company shares in the future, but at a price fixed today. So if the share price goes up because the company does well, they can buy cheaply and make a profit. The idea is to directly link their personal financial success to the company's long-term performance, make them think like owners. There are also things like restricted stock units, RSUs, which are basically shares granted over time.
Sounds logical on paper, aligned incentives. That's also where you hear that term fat cats, right? There's often a lot of public criticism about the sheer amounts.
Absolutely. That term reflects real public and, frankly, shareholder concern about the scale of some pay packages, especially when compared to average employee wages. It can look, well, disproportionate. And what really fuels controversy is when executives seem to be rewarded even when the company doesn't do well, or even for, well, failure.
You mean like getting huge payouts when they leave?
Exactly. Those large severance payouts, sometimes called golden parachutes. An executive might leave after a period of poor performance, maybe even preside over big losses, but still walk away with millions because of their contract.
That does seem hard to justify sometimes.
It's often contractually obligated, making it hard for boards to prevent, but it definitely raises eyebrows and leads to accusations of rewards for failure.
And this seems to be getting more sensitive. I saw a figure, I think from the UK, saying executive pay there has risen something like 3 times faster than average pay over the last 5 years.
Yes, figures like that really highlight the growing disparity. That gap, combined with those rewards for failure examples, is why executive pay is such a hot topic. It impacts trust, reputation, everything.
So how do companies manage this? Who actually decides these huge pay packages?
Typically, the board appoints a specific committee, the Remuneration Committee. Ideally, it's made up entirely of independent non-executive directors. Their job is incredibly difficult. They have to design pay structures that attract and motivate top talent, but are also seen as fair, justifiable, and linked to actual performance. It's a real balancing act.
And shareholders are getting more say now too, aren't they?
Yes, definitely. Reflecting that sensitivity, we've seen the rise of, say, on-pay initiatives globally. This gives shareholders the right to vote on the company's remuneration report. Often the vote is advisory, not binding, but a big no vote sends a very strong signal to the board. It pushes for greater transparency and accountability. It shows that owners want more direct input on how their money is being spent on executive rewards.
Wow, okay. We have covered a serious amount of ground today. From who actually sits on the board, the executives, the non-execs, even investors, and those different structures like dual boards, through to that whole debate about splitting the chair and CEO roles, and then finally diving into the very thorny issue of executive pay and how it's managed. Hopefully this gives you a much better sense of those structures. often invisible, that really guide these huge companies.
Absolutely. Corporate governance isn't just some, technical checklist. It's the framework that shapes a company's ethics, its strategy, its resilience. Understanding it helps you see why some companies thrive sustainably and others, well, stumble. For you, it's about looking beyond the surface, understanding the how and why behind corporate behavior and performance. It really connects to everything: long-term value, responsibility, trust.
Definitely. So maybe here's something to chew on. We've talked about these tensions, right? Strong leadership versus checks and balances, incentivizing talent versus fair pay. Given all that and the increasing spotlight on companies, how much transparency and maybe external influence from shareholders, from the public, do you think is actually optimal for a company's long-term health, but also its impact on all of us? Something to think about. We really encourage you to keep digging into these ideas.